Jignanshu Gore joining us this morning. He's director and senior analyst at Bernstein. Jignanshu, very good morning to you. And you've talked about the dark store picture as far as Q-commerce is concerned. Just outlay the basis for your report.
Sure. So one of the when you look at quick commerce as a retail business, the big question that keeps coming up in all our conversations is how far can the dark store land grab that started in 2024 last for the top three quick commerce players and then everybody else now, including Flipkart, Amazon, etc., who are growing their network as well. So that's the basis of our report. We try to understand where the current locations are, where are they going, what is the potential in each of these which is already being serviced, and we come up with some very interesting points in our view. uh, Three buckets, right? One is we feel that in the top 8 cities that we define as sort of metro cities, there already are almost 2,500 dark stores. So that's an average of around 350 per city, with something like NCR very heavily penetrated, Bangalore and Mumbai about in the 350 to 400 range. So the next rollout of a lot of dark store networks should be happening in tier 1 and tier 2 cities and so on and so forth. But the viability of those dark stores, how number of those dark stores remains the question. So that's, I think, the second point. And interestingly, we think almost a quarter of people in Mumbai MMR are broadly ordering through quick commerce every month, and I think that was a number that surprised us as well.
You're saying a quarter of people in Mumbai MMR are ordering on quick commerce?
Yes. So if you see, there are around, so we have the backup presented in the report on how we come to this conclusion. There are, of course, a lot of assumptions here, given the same consumers might be ordering through multiple platforms. But almost 20 to 25%, at least 1/4 to 1/5 of people in Mumbai are being serviced by quick commerce in one shape or form. So either their household is ordering, somebody in the household is ordering, or they are ordering for themselves through one of the 7 platforms.
Pretty much interesting data which you have given. But Jignanshu, I want to know about the three players in this segment: Blinkit, Instamart, Zepto. What are they doing? Who is winning? Who is losing? Who is stable? What's the entire report all about?
So on the between the top 3 players where we have the data for the dark stores, of course, Blinkit has the largest dark store network, with Swiggy, Instamart, and Zepto broadly neck to neck in terms of number of stores. Part of this is because Blinkit has been more aggressive in capturing a larger part of the market through retail store presence, but also in experimenting the viability of quick commerce in slightly smaller towns outside the top metro cities. So because of both of this, Blinkit's network is sort of double the size of Swiggy and Instamart. And they are growing also faster. As we know, Swiggy, Instamart has slowed down their network addition in calendar year 25. In our view, so has Zepto. And they have focused more on improving their own unit economics at a dark store level or at an order level. Whereas Blinkit had that sorted before these two, and hence it has tried to replicate the business and grew the network as well. So today, in terms of dark store network, Blinkit is the leader and sort of increasing the gap with the other 2 players as well.
Okay. Jignanshu, then my question coming to you here is, good morning, Hiral this side. What is the impact you're seeing with this kind of expansion, this kind of usage, in terms of the profitability timelines of these companies? Because you're assuming the 2,000 orders per day is what I was reading. Now, if the competitive intensity continues to remain high because there is an overlap, there is no brand loyalty that continues between a Zepto, Blinkit, or a Instamart. Whoever is giving you a better offer, that's where the buyers flock. How are you looking at that aspect, and what's the impact you're seeing in terms of financials?
Yeah, so I think there are 2 impacts of this. So far, over the last year and a half to 2 years, a large part of the growth surprise that we saw from both Blinkit and Instamart as the listed players came because the market was underpenetrated, and a quick sort of penetration seems to have happened. behavior change to consumers seems to have happened in metros, where a large portion of the stores exist. With where we believe there is a broad saturation level in metros, where the room for growth isn't as high in terms of new stores or in terms of even acquiring new users, uh, brand new users. We believe it is either about sort of getting users from the other platform, which you rightly said, Hiral, is about discounting, or it is about the other approach which Blinkit and Instamart have and Zepto are all doing as well, is saying to the same consumer that I can offer you everything, not just groceries. So we can offer you apparel, we can offer you footwear, beauty, cosmetics, home care, and so on and so forth, and expand the share of consumer wallet in that sense. Having said both of these, I think unless the competitive intensity sort of reduces a little, it's tough to see a scenario where anyone will make money. This is similar to what you would sort of harken back to a food delivery or a ride hailing apps when there was so much intense competition, and hence it's tough for winners to emerge and make a reasonable amount of margins. So the competitive intensity in 2026 that we see has pushed out the margin trajectory for both Blinkit and Instamart. And that is why the stock reactions in the last 3-4 months are have what they have been.
So, Jignanshu, to add to that, your valuation multiples, according to me, seem very steep. A 30 times FY30 adjusted EBITDA multiple for Blinkit and a 28 times for Instamart. What are those key performance milestones, according to you, that these companies should hit actually to justify these aggressive forward multiples?
So the forward multiple is just a small correction that while they are on F30 EBITDA, they have been discounted by 3 years to get to an F27, F28 numbers, right? So and the WACC that we use is around 12+%. So just a small point there. But having said that, I do agree that one is this adjusted EBITDA multiple. What is expected of these companies? I think two things. One is the growth number should not crash. And the assumption right now built into the models is it does not crash the same way that it crashed for, let's say, the food delivery business, where it came down from 100% to 20% in the space of a couple of quarters. The second is the sustainable margin profile is possible at around 4.5% to even 5% of EBITDA. That's the range which is possible. So margin trajectory and growth, very simply put, are the two metrics which we expect the companies to deliver in order to sustain both the multiple as well as the share price.
Just Zepto is IPO bound. You have Swiggy and you have Eternal right now in the listed play. How are they stacking up in your view, Jignanshu?
I think it's very tough to comment on Zepto beyond what we know of their operations, given the lack of data as they are a private company.
Let's make it about Eternal and Swiggy.
Yeah, so I think Eternal versus Swiggy are very different stages of evolution. Eternal is more about they have a very clear idea of their business, of their processes, their positioning within the customers, and they have so I would say the most sorted operational supply chain. Swiggy Instamart is younger, and hence the trajectory is different. So Eternal's objective right now is capturing as much market share as possible without going into the red in terms of adjusted EBITDA. Whereas Swiggy needs to hit its milestone of contribution margin profitability, right? So what we expect to happen over, let's say, the next couple of quarters is, in terms of order volumes, the growth for both of them may slow down a little compared to the previous quarters because competitive intensity has increased, and B, they are both going after they both intend to keep the profitability intact, and hence we expect a little bit of slowdown but an improvement in profitability over the next 2 quarters, and that's the approach that they have taken. They've also decided that deep discounting on grocery is unsustainable, as they mentioned multiple times in their shareholder letters, which again seems to be slightly different approach from what either Zepto or Flipkart or Amazon are doing today to get market share. So we see two kinds of approach, and the listed players and sort of the unlisted players are behaving differently today. So listed players better margins, but we expect lower growth.